All right. So yesterday we got to look at check out what happens when our we allow to have our customers allowed to owe us, and what happens if they don't pay us back. Now this one is kind of similar, right? Now this is called time value of money. We need to also assume that as we go on forth this business, we need to assume that money changes over time, right? So here it's called time value of money. Now, of course, we have
Your
these.
screen's really small. Sorry, I didn't mean to interject like that, but I'm seeing this. It's small.
Okay, so for you, you would have to go down to your white bar on your
Hmm.
Google
Oh,
thing
that's right.
and change the layout.
And that is in the three dots.
The not the three dots.
The,
It's at yeah, the bottom.
yeah,
The three dots, yes, and
yeah.
then
Okay.
change layout, and then you would either do spotlight if you want full screen, but that means if Michelle talks,
Why is it three dots?
it's
'Cause yesterday it was fine. I don't know. Weird.
yeah. Sometimes Google's not very friendly. All right, so here we are. So with time value of money, we have to remember that with time, the value of the dollar does change. So again, if we look back in the past, 20 years ago, a dollar was worth so much. It was hard to even make a dollar, right? Back then, everything was so cheap. You got bread for like 10 cents. You got things that were really, really cheap. And then look at it now. Fast forward, bread costs probably like $5 right now. Okay? And as we go on with society, the value of the dollar does decrease. Or in this case, it increases because more money in the United States means inflation, which means therefore a dollar is probably three times worth what it is now, in a sense of my $3 compared to 20 years ago. It took me forever to get $3. Now, with a new inflow of lots of inflation, okay, yes, we have stimulus, especially times right now, we have stimulus packages. So right now, we're at an all-time low for our money. Our money, our dollar is worth almost nothing compared to anything in the world right now because we're pushing so much money into the government. So, with that being said, we also have to think about what happens when we go into every year, right? We have to do, there's a person, not a person, like guess the government. They are the ones that's recalculating and they're telling you what the value of a dollar is worth. Again, you typically with society again, our dollar value compared to other countries has lost its value significantly. And other reasons that could do this is because of inflation. Maybe a recession's happening, or maybe there's an economic booming. We don't know. Right now, it is definitely more than a recession, it's a depression. But we are at a very all-time low right now. Okay, so you can. So with this is why we need to create or use the time value of money, so we can make predictions, so we can kind of get a better perspective of what it's worth if I were to invest or also maybe use credit cards. Okay, so this is for the sake of this class, we're looking at time value of money to apply for whether it's a bank loan, a bank bond, or some kind of savings account, okay? And typically most companies would like to have some kind of backup money or emergency money. So that's why they would invest in these kind of things. So typically, right, with the idea of a bank bond, right, having securities or something like that, you're trying to generate revenue based off of if you make a purchase now, fast forward in 10 years, it should accrue interest, right? And when you redeem it, then your value of that whatever amount that you originally invested in has increased or double or triple the amount that you originally invested in. So that's what we're going to be looking into, okay? And typical ones that we will, the two different types of time value of money that we will be looking at is simple interest and compound interest, all right? So I'm going to focus on simple interest first, and then I'll explain compound interest afterwards. So simple interest, all right? A key factor of a simple interest is that when we calculate our interest, it's generally only It's generally only calculated once, meaning you get a lump sum of money, you only calculate or you multiply the interest rate one time, and that's it. And then you get a lump sum of money after that, and that's your interest right there. So with this one, most typical that you would see would be a bank bond, because it doesn't accrue interest every month. Usually, typically, it's a one-time shot deal, okay? And what kind of variables will you see in this one? You'll see your principal, which is also known as your original investment. Then you're going to get an interest rate. All interest rates are going to be an annual rate, okay? There are some places that break down the rates for every month. But in this case, most in general, it's always known as an APR, an annual per rate, okay? So usually that will be in a percentage, and it's going to reflect for one whole year, or that's how much you're going to get charged the interest per year annually, okay? And then again, last variable you will see is going to be time. Time is sensitive here. Time is usually should be measured in years, but when we look at examples, right, that's not really true when we're looking at loans, right? Loans, you can either do 6 months loan, you can even do 1 month loan, right? So with this piece of information that you're given here, it should be in terms of years. And we'll talk about what happens when we want to convert it so it's not reflecting, so it is reflecting in years. And we'll do the percentages. So we'll talk about that later, okay? So we want to make sure that time is in terms of years, right? Now now let's put this aside real quick and talk about compound interest. Compound interest, right? Usually, you're going to have another key factor, which is going to be introduced to the number of times compounded. That means in 1 year, you're going to be hit or calculated the interest rate multiple times. All right, so typical ones you would normally see right now as of today is a credit card. You get hit interest every single month, all right? I've never seen a credit card that does 6 months or 1 year later. No, they give you an annual rate, and what happens is that it compounds every single month. So that means it gets recalculated interest every single month, okay? So that is an example, right? And most loans are going to be accrued either daily or they can do monthly depending on what it is. So most loans, most credit cards or anything like that, you are more likely to be compounded, okay? Because again, the banks or whatever company that you're getting a loan from or using a credit card from, they're out for your money. They're gonna charge you as much as they can to try to collect as much money from you. So the best way to do that is to compound you every month, okay? So with that being said, the variables, right, you're still going to have your principal. It's still going to be your original investment. Then you're going to have your interest rate, which is again another annual percentage rate. And then you're going to be introduced to the new key factor here, which is going to be the number of times compounded, also known as N, right? Which is basically how many times are you going to be hit with the interest. And then lastly, time, which should be measured in years. Okay, so let's go ahead and go back to our simple interest and let's learn the simple one first. So simple interest, so here when we're doing simple interest and we're using the time value of money, we want to be looking at two formulas. We want to calculate how much interest are you going to collect in the time that is measured, right? You want to be able to predict how much interest you will be collecting or will be paying for, right? Depending whether this is a bond or not, okay? So you want to know how much that is. Second thing is you also want to know what is your prediction in the future. So if I buy my bank bond today, what is it going to be worth in X amount of years, right? So that's a good projection line right there, is making a prediction of if I were to invest $1 today, what is it going to be worth in 10 years, right? Something like that. So that's what you want to do, and that's what these formulas are here for. Now, in order to do that, because simple interest, I will tell you it's the most simplest calculations, because all you need to recognize is those three variables that I just talked about. We need to deal with our principal, we need to deal with our rate, and we need to deal with our time. So for the very first one, interest, right? You're going to multiply your principal times your rate times your time to get your interest, right? Also known as pretty. If you think of it this way, right? PRT equals I, pretty. Okay. Second thing that you're going to be looking for is what is the future value, which is going to be your principal, which is your original investment, plus your interest. So P plus I equals F. All right, FV, so PIV, if you want to think of it that way. Okay, so your principal plus your interest is going to give you your future value. All right, so let's go ahead and look at an example here. Example is going to be you bought a bond from the bank worth $100,000. Okay, the interest rate is going to be 6%, and it is going to be for or redeemable in 5 years. So here we have our principal. Our principal is going to be $100,000. Our rate is going to be in terms of percentage. Now, in calculations, we need to convert the percentage into decimal points. So in this case, 6% is going to be 0.06. And time is already in years, so it's going to be 5 years, right? So there you go, $100,000. You're going to multiply by 0.06 and times it by 5, which is pretty. So PRT equals I. So we're going to multiply $100,000 by 0.06 times by 5. And what do we get here? What is my interest going to be?
Is it 30,000?
Yes, 30,000 is correct. All right. Now let's go.
Sorry, I'm over here talking and my microphone's. I'm like, how come you can't hear me? Okay.
And that's what I was thinking the
Like,
same
I
thing.
said that same thing. Oh, damn it, I'm muted. Okay, sorry.
All right, no worries. I felt the same way. I was like, you're very quiet.
Yeah, no, I was like, hey. Okay.
Okay, so here now, so our interest is going to be $30,000. Now, how can I make my projection or my prediction in the future of when I redeem it in 5 years? How much is it going to be worth? What's my future value going to be?
That is 130,000.
130,000, right? It's P plus I, which is your original investment, plus your 30,000 equals 130,000. And that's it. That's how you do simple interest. I told you. Very easy, very simple. You just need to do PIV and pretty. Okay. So now again, that was simple interest. So now here, this is compound interest. Now how compound interest works is it's going to be a little more complicated formula. You cannot calculate this on a regular calculator.
Okay.
And the great thing about Excel is you're able to do a lot of many different functions and formulas in Excel. And I will show you how to do it in Excel. All right? But first, let's go ahead and talk about what the formula is in the first place. All right? So again, this time we're adding another component, which is the number of times it's going to be compounded for. So in order to calculate the interest is actually the future value minus the principal. So in this case, you need to solve for the future value first in order to solve for the interest. Okay? And in order to solve for the future value, it's going to be the principal times parentheses 1 plus the rate over the number of times compounded, close parentheses, exponent, what's it called? Exponented, exponent, I don't know how to say that, with the number of times compounded times time. So in this case, if you look at the very bottom, this is what I mean. It's going to be raised up to the NT power. Okay, that's what we call it in math. But in accounting, you're going to, it's going to be exponented. Okay, so here we go. P, your original investment, okay, it's going to be times 1 plus the rate over N, right? And that's going to be raised to the N times T power. Okay, so what does that mean? Well, let's go ahead and take a look in our example. All right, so example here is the same scenario, except, so you bought a bond for $100,000, okay? The interest rate is 6%. However, the number of times compounded is quarterly, all right? And again, it's going to be redeemable in 5 years. So your principal here is $100,000. Your rate is going to be the 6%. Numbers compounded. What does quarterly mean?
4 times a year.
Yeah.
You're going to be recalculated with the interest or hit with the interest 4 times in 1 year, meaning every 3 months your interest is going to be calculated, and then time is going to be in 5 years. Okay, so that's exactly what that is. So with the formula here for the future value, it's going to be P times 1 plus N, R over N, up
Hold on a minute,
to
I'm gonna
the,
write that down. Don't move. Oh, you can keep going, I'm sorry.
okay. So here, this is where I'm going to show you how to do the Excel, all right? So I want you to follow this very carefully because I told you, like I said earlier, you cannot do this on a regular calculator, okay? Unless you have that really nifty scientific calculator that allows you to do the exponents or the little caret, we call it. Okay. So in Excel, you have no worries. You can do this. You can type in this formula in Excel. So how we're going to do it is P times open parentheses 1 plus open parentheses R divided by N close parentheses. Make sure there's 2. Then you're going to do the caret. Then you're going to do open parentheses N times T close parentheses. And that's how you're going to type the formula in Excel. Okay? Now, of course, with that being said, right, so here I plugged in my numbers here. So my future value is going to be $100,000, right? Plus, 1 plus 0.06 divided by 4, okay? That's going to be raised to the 4 times 5 power, okay? And I already did the calculations for you, but if you'd like to try it,
I'm trying it right now,
okay.
just to see. Hmm, that's not right.
Now you have to be very careful when you're dealing with Excel because Excel is very precise. If you have an open parentheses, you need to have a closing parentheses or else it will stop you with an error message saying this is an inaccurate formula.
I gotcha.
Okay?
Okay, never mind, I did something wrong.
Okay?
All right, I'm gonna watch you for a minute and I'll have to keep trying.
Okay. So
Sorry.
to calculate this, right, we just punch in the formula, right? And I'll show you how to do it when we go into the exercises.
Okay,
Okay.
good.
So there you go. Here it is. So when I get that, I should get $134,685.50. All right. So that is my total future value. So then how do I solve for my interest?
You take the future value and you subtract the principal.
Okay, so how much is my interest that I'm going to collect off of this bank bond right here?
$4,685.50.
Yes, 34,000.
Yes.
Okay, so good.
Oh, it's the whole, okay, the 34. Okay, yeah. Sorry.
Yeah. So you're going to get 34,000. Now, it is not true that comparing simple interest and compound interest that you're not going to get a better output if you do compound, okay? It's just depending on the scenario, what the situation is, and is it worth it, okay? Especially when you're dealing with a bond, of course you want to maximize your the amount of times you're going to be hit interest because that means that's more money for you. But when it comes to owing a credit card or a bank loan, you rather have it compounded less. All right. So with that being said, so that's how you solve for that portion there. So that's where I'm going to go ahead and pause here because we're going to go. I just realized I pulled up the Word document when I needed to do the Excel sheet so I can show you how to be able to calculate the compound interest. So let's go ahead and do the exercise real quick. Okay, so here it is. I'm on question number 1. So question number 1. All right. If you bought a bank bond worth $225,500, right? And a simple interest rate is going to be 7.45%, right? And it can be redeemable after 3 years. How much interest will you collect and at the end of 3 years?
$50,399.25.
All right, so
Just the interest.
okay, so the interest was calculated just like this, right? If you take the principal, you multiply it by the percentage, and you multiply it by the years. And I realize my percentage is actually off. It's actually supposed to be 7.45%. All right. So here you go. What did you got that answer right? 5,399. Is that what you got?
$50,399.25.
Okay, let me
Cause your 7% went to seven, or your rate went to 7% instead of 7.45.
It's because the way I formatted my
Oh.
Excel. So
Yeah, mine's doing that too.
there you
see what you're
go.
saying.
So if I were to set it up to show me two decimal places, there you go. There's my 7. There's my 4 or 5%. So yes, you are correct. It is equal to $50,399.25. So what is my total? What is my total future value going to be?
Is $275,899.25.
Good. So there you go. I placed accounting on there. So there you go. That means my bond is going to be in the future going to be 275,899.25 cents. Okay. So that's all. That's in 3 years. That's not bad. The interest rate is pretty good. So you're collecting $50,000 worth of interest on top of what you've originally invested in for. So good. All right. Question number 2. So let's go ahead and go over these examples here of just doing simple interest. So for the first one, what is going to be my interest for the first one? Okay.
For that one,
Mm-hmm.
I have, the interest is $3,840 even.
So you're going to take 15,000, you're going to multiply by the 5.12%, and you're going to multiply it by 5 years, right? And you're going to get 3,840 even.
Correct.
Good. So then that brings my future value to be
Total of $18,840.
good.
Principal plus interest.
Good. Principal plus interest is going to be 18,840. Good. Now, what about this one? What about the interest for the second scenario, right? If you invested $4,521.50, your interest rate is 2.45%, and it's only for 90 days. How are you going to calculate this?
You want to
Is
go,
it gonna be
Michelle?
Is it gonna be like 0.25 of something?
Point.
Because it's like a quarter of the year?
Good. How many? Okay, so let's do that right now. So how many days is in a month?
30,
30.
30 to 31.
Yes, so 30 is going to be 30. Okay, let me just write it here. 30 days equals 1 month. Okay? Since we have 90 days, so therefore we have equivalents of how many months?
3.
We have 3 months. Good. Now, because we are looking in terms of years, how much, or how long is 3 months out of a year? In fraction
1
ways.
quarter.
1 quarter, right?
0.25.
So we know that means, right, 12 months equals 1 year. So here we need to look at it. If we only have 3 months, right? So 3 out of 12 gives you 20. Oh, not the date. But it gives you 3 out of 12 gives you a quarter. Whoa, okay. 3 out of 12 gives you a quarter, right? Because that's exactly how much that's exactly how much what the time is. It's only a quarter of a year. So now you can go ahead and calculate it. So what is your interest going to be? What is your interest going to be?
You're just looking for the interest, right?
Correct.
Is it $276.94?
200. How did you get 200?
Oh, that's not right.
Okay, so
Because it's only $4,000.
okay, so let's
All
let's
right,
do
so
this
I'm
again.
gonna take the. Oh, you know why? Because I know what I'm doing. 4,521 times 2.45%. All right, how about this? $27.69.
That's exactly what I got. Perfect.
All right.
All right, then you add those to get our future value. And what's my future value?
Nope, that's not right. $4,549.19.
Good. All right, so because it's such a short term, that's what happens. Okay,
Okay.
you don't collect that much interest. Okay. What about the last one? This time, everything we have, we invested $384,125.22. My interest rate is 7.89%, and I'm only given it for 6 months. So, what is my 6 months going to convert to?
0.5.
Yes.
So, let's see here. 3, 4, 6, 8, 9, that's 0.5, correct, you said?
Yep, correct.
Because that's half the year, all right. I have the interest at $15,153.74.
15,015,374, correct.
Bringing that total principal to future value of $399,278.96.
Good. Right? And that's how you do simple interest. And this is also dealing with time that is not in years. You need to convert it in years because the rate will always be given to you at an annual percentage. It will never be less, never be more. It will always be an annual percentage. So therefore, you want to make it consistent throughout. So making the time into years, all right? And you'll see this be more prevalent when we move into the next chapter, which is chapter 11, okay? So now that we have that, let's look at question number 3. So question number 3 says, now we're dealing with compound interest. So up here, I placed the formula for you so you guys can remember it. Okay, so number 3 says that you were approved for a bank loan for $5,500. Okay, the interest rate is 6.25% and is compounded monthly. All right, and how much interest will be collected if you decide to pay it off in 5 years? All right, so we'll take it slow. Okay, I'll zoom in bigger so you guys can see what I'm doing. Okay, so I'm not going to cell reference. I'm just actually going to type everything in so you can see what I'm doing, right? So I'm going to start my equation. What is P?
5,500.
500.
5,500, okay? I'm going to go ahead and throw my asterisk to say I want to multiply. And now I'm going to open my first parentheses. I'm going to put my 1 because it's 1 plus the rate. So now that I have my 1 plus, I need to open up my another parentheses, right? What's my rate?
It's the 0.0625.
0.625. And then I'm going to throw in my division, okay? And how many times is it compounded? What's the number?
12.
Good, because it's compounded every month, right?
Right.
So there's my first parentheses. Here's my second closing parentheses, right? You need two. Don't forget it. All right. Now I'm going to go ahead and add in my caret, which is shift 6. All right. I'm going to open up a new parentheses, right? What is my n again?
What is your what? I'm sorry.
My n. My number of times compounded.
Oh,
Is it the 5 years?
The number of times compounded.
Oh,
what do you mean the number of times compounded?
That's part of the formula. What is the number of times of compounded? How many times am I going to get this interest hit me?
Oh, 5 times.
That's how many years I'm going to have it.
Okay. 12.
12. Good. Yes, it's the same number. All right. And then now how many times am I going to now how long am I going to have this bond for? Or when's my time?
is it gonna be the 5 finally?
Now it's time. Yes, now it's
I'll
5.
stick with it, it'll come through.
All right. So then here is my formula. All my parentheses are in the correct areas, and my caret is right in between the n and the t. I mean the nt, right? So if I press enter, I should get 7,511 and 51 cents.
That's what I got.
Yay!
I had too many decimals, so I had too many. But yes,
Yeah,
I
I
have
have
the same
that
thing.
too.
Okay.
Good. So then, what is my interest I'm actually going to be paying?
So we have to. $2,011.50.
Good. $2,011.51 because that is how much interest I will pay for this bank loan. And that's a lot. That's almost half. Right? And this
It's like a payday loan.
exactly. So make sure you understand. And this is why it's very important because a lot of businesses, they go to the bank, they just get a bank loan and don't realize what they're getting themselves into. Okay, so this also applies to home mortgages, and then that's why when you do purchase your own home, right, you want to see which interest rate and how long it's going to take you to pay it off and see how much interest you're actually going to be paying towards the actual bank loan. So this is a good technique that you can use for the future, whether you're making decisions to invest in something. All right. So there you go. I'm going to be paying $2,011.51 in the course of 5 years. That's a lot of interest. Right? So let's go ahead and move on to question number 4. So question number 4 is quite similar. We are going to be dealing with the same numbers in the same things, except we have a new column here for the number of times compounded. Okay. So let's go ahead and practice that formula. Okay.
Okay. Oh, let's see here. What in the heck?
So we're going to take 15,000, right? The first one's 15,000 with 5.12%. You're going to be compounded 4 times a year. And you can either redeem or pay it off in 5 years. Oh, see, I already messed up my formula. I forgot a parentheses. All right, so 1 times r divided by 4.
Okay.
Okay.
I'm gonna step away for just a minute. I'll be right back, guys.
That's fine.
Okay. Okay, I'm stuck at the last. I did my caret, and now I have a parentheses, and now I can't remember what goes in there next.
The number of times compounded. N.
The what?
N.
LN? Wait. I don't put the letter N.
No, 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 no. What is the
So-
number of times compounded?
Because, well, here, let me read what I got to you so far and make sure because I think I already put the 4 in.
You put the 4 in twice in this formula.
Oh, I do. Okay, okay. That's why I was like, wait a minute, I'm doing that. Okay, so the 4
I'm back.
times the 5, right?
Mm-hmm.
Okay. And then the final parenthesis. Let's see what I get. All right. I have a future value, if done correctly,
Mm-hmm.
of $19,344.84.
All right. And that's exactly what I got too.
Me too.
All right, good job, guys. Oops. Let me hide that. So it's 84 cents, okay? So that means how much interest am I collecting?
Okay, so that is future value minus $4,344.84.
Good. All right. Now again, I'm throwing in different times. So we've solved already for what it was in the previous question or the one before that, question number 2, right? How much time is 90 days?
0.25.
Right.
Yes, would equal 3 months divided by 12 gives you 0.25. What about 6 months?
0.5.
Yes, 6 divided by 12 is 0.5. So go ahead and tell me what is the future value if you invested in $4,521.50 with an interest of 2 and 45% when you're being compounded twice a year and you have 90 days. All right, where are you stuck, Robin?
I am stuck. Let's see here. I put in the amount times the 1 plus parentheses 0.0245, and then the division mark. And that's it. And now,
How many times compounded are you? What's the number of times compounded?
man, that's what I gotta remember. How many times compounded is 2, right?
Mm-hmm.
Okay. And then, T, parentheses, caret. And now I'm stuck again. So after the caret, now I'm doing the time.
You could do time first. You could,
Oh, no. Damn, this is right. This is where I got caught last time. So it's 2 again.
yes. You're doing the number of count times
And then
compounded.
times
Yes.
the 0.25, right?
Correct.
Oh, okay. Oh, typo. Shut. I found a typo. Where did you? Okay, maybe it's the. Because in the beginning I put the 4521.50, right? The amount in the beginning times. I don't know why it's telling me it's not right.
You might be missing a parentheses. You might be.
Oh, maybe. Let's see here. Okay. I had the amount as 4,521.50
Mm,
times parentheses
mm,
1 plus parentheses
mm-hmm.
0.0245 slash mark or division
Mm-hmm.
2 parentheses. Oh, sorry, I forgot a parenthesis. Okay. Let's see what happens now. Okay.
And what did you get?
I got an amount.
Of?
Oh, okay. I didn't know if you wanted me to go or her to go. $4,549.11.
Good.
Okay.
Bringing your interest to be.
Let's see here.
I did something wrong.
Wait. $27.61.
$21.
No,
Whoa.
27. Yeah, that's what I'm like. Wait, what?
Yeah, give me a second. I think I hit the wrong number too. So this one minus this one. There you go.
Right. 27.61. Yeah.
2761. Good. All right. So let's go ahead and finish the last one.
I don't know what I did wrong.
Which one? What are you? Are you stuck?
Well, on that second one, I came up with a different amount, but so I it must have had something to do with the time. I'm wondering if I didn't put the right period in there, like the decimal point or something.
For time?
I don't know what I did.
Okay, so
I'm gonna go back.
go ahead and here, I'll go ahead and help you on that. So, what did you do? Read me your formula.
I don't know how to get the formula back this way. Oh, here it is. We found a typo in your formula and tried to correct it. Nope, don't accept it. The formula is missing an open or closing parenthesis. Oh, it's my last one. That's why. Hang on. Okay. I don't know how to get the formula back open in Excel.
Okay,
All right.
so what you?
I'll go. Okay. So I'm on the other one. So I know I had to have missed something up with the. I'm assuming it had to do with the 0.25 at the bottom. Let me try. Let me try it again. Okay. Do you want to do the next one, or do you want to go back to the other one that you guys already did?
Hold on. Yeah. We could continue to do yours first. So, to edit your formula, what you do is, so hold on. So you've already, it's there, right? You just double click it, right? And at the very top of your bar where it says formula, that's where you can actually start fixing your formula.
Oh, look at that. Okay.
Yes.
So this is what I have in.
Okay.
Where I'm missing. So I have my equal sign, and then I have my amount, which is the $4,521.50.
Good.
With a star.
Good.
And then I have my parenthesis.
Good.
1 plus. Then I have another parenthesis. 0.0245.
Okay.
Okay. Slash divided by whatever. And then I have the 0.025.
Okay, so that you don't put time there, you put the number of times compounded.
That's what I did. So that's just going to be the straight 2, not the 0.25.
Correct.
And then I'll have parenthesis,
Mm-hmm.
caret, 2
Mm-hmm.
times point.
You needed another parenthesis there.
Yeah, I have 2 parentheses and then a caret.
Good.
And then a parenthesis. 2 times 0.25 parentheses.
Good.
Okay, that's what it was. I had the rhyme in there.
Okay.
And now I have the same amount that you guys had.
Good. So let's go ahead and do this, the third one. So I'll quickly do it.
Sorry, guys.
All right. So Robin, did you already do the third one?
Yes. I think I did it right. We'll find out in a second. So, for the future value, I came up with $396,191.44.
Okay, I did not get that answer.
Then I did something wrong.
Okay, so let's do it again.
I did. So I have the amount of 384,125.22 times parenthesis 1 plus parenthesis 0.0625. Oh, wait, that's why. It's not 625, it's 789.
Yes, 789.
So I can change that right here. I don't have to redo the whole thing. Right?
Mm-hmm.
So it's 0.0789. And then divided by 3, parenthesis, caret, parenthesis, 3 times 0.5. And that's going to be, okay, 399,378.16 cents. Why is it so
Hold on,
long?
hold on. That's what I had before. Let me redo my calculation, see if I might have typed something in wrong as well. So plus,
Got the time wrong.
what did you put for time?
No, I have 5 or 0.5,
Mm-hmm.
right?
Yeah.
Okay.
There you go. So I got 399, 378, 16.
Okay. And so,
Yay. Okay, so now we find out what the interest is.
I came up with the 15,000 $15,252.94.
$15,252.94. Correct. Good.
Yeah.
All right. So then, question number 5. Now, this is something I'm going to have you guys follow along with me for, okay? Because this is going to be a difficult one. Okay?
Great.
So, number 5 says journalize the bank loan from the example number 3. So, we're going to go question number 3 to check out what that bank loan was, okay? The bank loan was made on June 1st, 2020, all right? Monthly payments, okay, are variable, all right? So depending on how much we want to pay, right, is what a monthly payment is variable for, right? And due every first of the month, right? There are no hidden fees and 0% APR, all right, on the bank loan is effective immediately. All right, so journalize the first 3 months. So, first thing first is let's go ahead and figure out how much that loan is for on question number 3.
Okay.
So are we doing the 5,500?
5,500. Yeah, that's our principal, right? The same interest, right? And the same you're getting monthly charged, and you have 5 years to pay it off. Okay, so in this case, what is our principal going to be?
The 5,500.
Yes, 5,500. Now let's go ahead and journalize this. So on June 1st, what did you do?
And we received a loan.
Yes, we did. And what do you actually receive once you use a bank loan?
Equity?
Not equity.
Asset.
Yes, what kind of asset?
Jeez, oh, Pete.
I know.
Think about it. What happens every time you borrow money?
It's a liability.
It is a liability, but what are you receiving from? What are you getting out of
Money.
money?
Cash.
Cash. Good. So here you go. First thing is cash. You're going to get cash because you decided to have a bank
For
loan.
cash.
Okay? And how much was that bank loan for?
5,500.
So you got $55 cash in the bank. All right, hold on. Let me fix my tables. Why are they all like this? All right, so here I want them to be left aligned. All right, and I want all these to be in dollar format. Let's do dollar format. Okay, so there you go. 5,500. And what's my credit going to be?
5,500. Oh, sorry.
Mike, okay. But what's my account going to be? What did I do?
Loan.
Yes, you got a loan. Right? Now, what happens when you have a bank loan and you immediately borrow it?
You create a liability.
Yes, but what comes with the liability?
Interest.
Interest. Now, question to you. Do we get charged interest the minute we get our bank loan?
No.
No. It's always charged after, right? You have to accrue whatever it is, right? So here, month of June, all right? So now we're going to calculate for what the bill is going to be for, okay? So future value. What's the future value? If my interest rate is going to be what scenario 3 says, so my percentage is 6.25%, and I'm compounded 12 times, and I have 5 years to pay this bank loan off. So what's my future value going to be?
equals $7,511.51.
Yes, so in this case, I'm going to retype in my formula here. All right. 1 plus, oh gosh, 0.0625 divided by 12, close parentheses, up caret, open parentheses, 12 times 5, okay, gives me a total of $7,512.51. Now, how much of that is actual interest?
$2,511.50.
Right? This is how much
Or
I'm,
$2,011.
yes.
Yeah.
This is how much I'm going to be collecting over a span of 5 years. Now, I'm doing monthly payments. So, how am I going to determine how much monthly interest I will be charged?
You're going to divide it by 60 months.
60?
These are 12.
Would it be 12 months or would it be 60 because it's for 5 years?
Ooh, that's a good question. What do you think it is?
I think it's 60.
60.
60.
Okay, so in this case,
So the interest is $33.53.
say that again. 33,
33.53.
33.53. All right, so that's how much I'm going to be accumulating over 5 years. So, because we need to divide it by the 5 times the 12 months, so $33.53 is going to be your monthly interest. So that means, what is your current balance going to be?
Oh, that is going to equal this. Shoot.
$5,533.53.
Correct. So that's what your bill is going to look like. It's going to be, your monthly bill is going to appear this way. So you got charged $33.53 worth of interest. So now you're going to make a payment on July 1st. So here I established that I want to make a payment for $200. Okay, so let's go ahead and journalize this. Okay, so on July 1st, I'm making a payment to my loan. All right?
Mm-hmm.
So, how am I going to do this?
Accounts payable.
Not accounts payable. What are we reducing?
It's the bank loan.
Bank loan, correct.
From checking.
Okay, there's one thing that you forgot to calculate too.
Oh, damn, the interest.
The interest, right? Normally, all right, this is true in all ways. When you actually pay towards your bank loan, you're always going to pay the interest first.
Okay.
And then the rest of the money goes towards your actual principal. Okay?
Okay.
So, how much am I paying towards my interest?
$33.53.
$33.53. So this is going to be interest expense. Okay? And you're going to be obviously writing a check, or I don't know how you're going to pay it, or maybe you're doing online payment. But it's no matter what, it's going to come out of your checking account.
Checking, right?
All right? So if I made a payment of $200, right? That's what I said. I said my monthly payment for this month of July is going to be for $200. My interest was $33.53. $33.53.
Loan is 166 and 47 cents.
Yes, so what actually is going to my principal is going to be my 166.47. Okay, so therefore, my new principal, right, is going to be my current balance, right, minus my $200,
Right.
right? It's going to be your bill, right? Oops, your bill of
Okay.
55.33, right? And you're gonna minus your payment. Okay, so now the balance that you're gonna be charged another interest is going to start off now with $5,333.53. Okay, because you pay $200 to it, right?
Mhm.
So now we have to recalculate what the future value is going to be
Oh my gosh, you have to do that every month.
every month, and that's exactly why. No, it's a good thing because when you are actually looking to your credit card, right, you're actually going to look at how much interest you're actually paying every year. If you've been in finance, right, you'll know that 22 rule or something like that, something called like that, where every year that you don't pay your bill off, it doubles twice as much, something like
Yeah.
that. This is exactly what it is.
Okay.
All right. So yeah, so let's go ahead and recalculate this. So this time my new principal is 5,333.53.
Oh, crap, I just messed it all up.
No worries. You can always enter in the cell and clear it out.
Oh,
Okay. Did I do this right?
So what did you get for your new
All right.
future value?
So future value, I have. Yeah, it's more. What did I do? I have $7,557.31.
It's actually
that's what I heard.
less than that.
What
Yes,
did you
exactly. It
do?
was less. Well, because I took the current balance.
Not the current balance.
Okay,
Your
so
new principal.
principal. Oh,
You got to take your
well,
new
where did I come up
principal.
with the?
Because your current
Where?
balance, right? This is your bill. This is what you're receiving in the mail, right?
Okay, well, what is my new principal then? If
Because you made a payment.
I know, but where does that reflect that? Because underneath I have the current balance, and then it went to the 50. I looked. Oh, I see. Ah,
So your current balance is up here, right? This is what your bill statement should
right.
reflect, the 5533, right? Because you made a payment, right? That means your new principal is going to be 53,000 or
Okay.
5,003.
Minus that from the 200. Oh, okay.
Yes.
You're right.
Yes. And then you're going to
And I just carried the old one over through.
Oh,
I did
okay.
the same thing.
Oh,
I
okay.
did the same thing.
Okay.
So yeah.
Oh, and now I have to do that old formula over again.
You can do it.
No, I don't.
Y-
No, I don't. I just have to change the amount on the
Yes.
box up.
Good.
Uh-huh.
Good.
Phew. I'm glad I saw that before I went ahead and did it. There we
All
go.
right. So,
Goodness, so my new total
hold on.
is
I erased mine. So 0.0625 divided by 12, close parentheses, caret, open parentheses, 12 times 5. All right. So what is your new amount now?
new amount is $7,284.16.
You,
7,284.16. Oh,
how did you get?
Mine says 16 also.
so what did we do?
I wonder if we have something in ours for rounding something.
Oh, okay. So I get it because you. Okay. So in my
Maybe we have
Oh,
yeah,
our rounding on.
that's fine. That's fine. So that's how much you're because either way at the end of the day, that's not what we're paying. That's not the interest that we're paying. We have to divide it by how many months?
how much was this one? It was
It's gonna stay the same because that's how much you're potentially planning to pay for it. You're not extending the time. So what is the monthly interest you're going to be collecting? The loan is for 5 months. For 5 years. How many months is in 1 year?
12.
12. And you have this this loan for 5 years.
5 years. So 60.
60.
Okay.
Oh, what the heck? I'm sorry. What's my, okay, so my interest is going to be 1,950. And that's what I'm going to take divided by 60.
Okay, I messed something up.
So how much interest are you going to be collecting? How much actual interest are you going to have?
Oh, that's what I messed up. I had total wrong amount. So how? Right now, I'm starting to make myself mad. So I'm doing my formula again to get my interest.
Okay.
I messed it up. I did not have 1950.63. So
Okay.
how?
How did I do that?
Yes, please. So
So the formula is you're going to take your future value minus your principal.
okay, there we go. All right.
So did you get 1950.63?
Yes, now I have it.
Perfect. Okay. So now I want to know how much interest is per month, right? We did not extend the time for our bank loan. We're still going to pay it off in 5 years. So we're still dividing it by 60 because that's a total of the 5 years. Okay? So 1950 is your total amount in 5 years. All right? We want to know how much is it going to be for the current month?
All right. I need help with the formula again. I don't know why. So the 1950
Yes. Okay,
I have
1950.
yeah. So I have my I'm trying to do my formula that equals the 1950,
Good.
and then it's how am I figuring it? What am I using next? I have
Okay, so
I have to write
how
this down.
how long is the loan for?
Okay, the loan is for the 5 years.
5 years. Now, I want monthly.
So 30. Are you doing 30 days or
No. I want to know how many months are in 5 years.
oh, okay, 60,
60.
right? So am I dividing the
Yes.
1950?
Yeah,
Okay,
because
by
this, okay, so 1950 is how much you're going to accumulate in a total of 5 years.
okay.
I want to divide that by the total of the 5 years, but
5 years.
not only 5 years, I want to know how much months. What's my monthly interest? So how many months are in 5 years?
That's the 60. So now I came up with $32.51.
There you go. So that's how much monthly interest you're going to be charged. So therefore, my new current balance is going to be that what I'm going to see in my bill is going to be what?
The new principal
Yes.
plus 3251 is $5,366.04.
Good. All right. So now I'm on June, July, August. August 1st, I decide to pay $250. Excuse me. So I'm going to journalize this right now. On August 1st, 8-1. Oop, one more down. 8-1. All right. I'm going to make a payment to my bank loan. Right. My current balance is going to be for the $5,366.04. Okay. If I'm making a payment of $250, how much is going to my actual loan and how much is it going to go to my interest? Okay. Okay. First thing's checking.
So the checking amount that we're paying, 250, you said, correct?
Correct.
Right?
Mm-hmm.
Okay.
How much are you actually paying the interest?
3251 is going into interest
Yes.
expense.
Good.
51. So, yeah. So we're
Oh, I'm sorry.
bank
It's in the
loan.
wrong side.
Sorry.
My bad. The 3251 on this side. Okay.
Okay. So we're in the bank loan column. We're paying $217.49.
217.49. So that is the amount that's actually going to your actual bank loan. 35 or $32.51 is going to the interest. Okay. So now that I made a payment of $250, now I'm going to reduce my current balance, right? If I started with 5366.04, and I paid $250. Therefore, my new principal is going to be $51.16 and $4.04. Okay. So go ahead now. Let's do the last one. Recalculate the interest. Michelle, did you already calculate the new future value?
Yeah, so when I went through, you guys took the $250 and subtracted it from the principal amount that was like the 533 something, right?
Yes. The current balance.
But
Yeah,
I came
current
up,
balance, not principal. Current balance at the far other end.
you subtracted it from the current balance or from the principal?
From the
Current
current
Balance.
balance.
Okay. I gotta make sure I put the right number in.
Okay.
Well, I think I got it, but I'll let Michelle do this one.
Yeah, I forgot a set of parentheses.
I know, I keep forgetting.
Okay, so let me make sure I have everything in there before I say an answer. That's my rate, my time, parentheses, caret, parentheses, yes. Okay. Oh, I shouldn't have letters.
Okay, that means you entered in something that is incorrect. So it's an error. Syntax error, they call it.
Okay, so I have the 5,366, y equal 5,366.04.
Hmm.
And then times, and then parenthesis, 1 times, parenthesis, 0.0625
Hmm.
divided by 12,
Hmm.
parenthesis, caret,
Hmm.
parenthesis, 12 times 5, parenthesis.
Hmm.
And it's giving me an error message.
Did you do 1 plus? Because I heard you said 1 parentheses.
I did 1 time. There we go. One plus. And let me turn it into. Okay. So I came up with $7,328.56.
Okay, I did not get that answer.
No,
So-
what amount did you use first? Did you use the 536604, did you say?
Yeah, that's what you guys said.
Yeah,
No.
you forgot to subtract the 250.
There's 50 from that. So it's the 51116.
511.
Well, 511, well, 5,116 and 4 cents.
Got it. Let me change that. That's what I was asking in the beginning. Okay. That's
Okay, so in order to fix your formula, all you do is go to your cell and double click, and then you'd be able to fix it right at the top of the window.
$6,987.13.
Okay, good.
That's what I thought.
Good.
You have 12.
Yeah, you
I,
have 12
I,
cents.
I had 12 because my numbers are, it's not formatted.
Okay.
It's not formatted, so they're just numbers.
Okay.
So if I were to extend it out, it says that I should have it, right?
Okay.
But that's okay. That this number doesn't matter. Remember, because that's not what we're calculating. Okay. So what is the total interest that you are going to be collecting over the 5 years?
$1,871.09
Good. And
divided by 60
mm-hmm.
gives me $31.18.
Okay. See, so this is what happens, right? Why is my interest a lot higher the first time? Because I didn't pay as much. Now that I paid more, my interest dropped. All right. And that's how, when you look at your credit cards, right? 1 month you pay the minimum, it's going to charge you a high interest. The minute you say, I dump a bunch of money in there, your interest drops significantly. And that's the reason why. All right. So, with that being said, how much is my bill going to be for? What's my current balance?
$5,147.22.
Good. All right.
Plus.
How did you get that though? I was typing something in and then I looked up and the number was there, but I'm not exactly sure. I know you added something, but I can't remember what it was. Can you tell me real quick?
So on your bill, right, you're going to have your
Uh-huh.
new principal, right?
Okay. Uh-huh.
Plus the interest, and that's
Yeah, I see it now.
that's going to be your
And that's
current
your
balance.
current.
Yes.
Okay. Got it.
All right, that's what your bills,
Sorry.
that's what your statement's going to reflect. It's going to be your new value, including the interest. So they're going to add the interest, so then it looks like what you owe or what you paid for didn't reduce significantly, even though you paid already so much. But again, you're paying towards the interest, not the actual principal.
Right.
So in this case, so now my new value is going to be 5147.22. Okay, that's my current balance on my statement. Now on September 1st, I decided to pay $300 this time. So let's go ahead and make that payment for September 1st. So September 1st. Okay. How much is my payment?
It's going to be $300.
$300. How much was my interest for that month?
$31.18.
$31.18. So how much money is actually going to your principal?
Oh no, yeah.
Shoot, I'm on the wrong side again.
$268.82 is going to be my principal reduction.
Yes, $268.82 is going to be actually going towards your actual loan. All right. So if you'd like to do for more practices, go ahead and solve for the rest, but you're not going to make a payment. But other than that, this is how you figure out your credit cards or bank loans or anything like that, right? This is what you're going to do. This is if you want to do it for fun. I don't care. If you want to look at your credit card bill, this is exactly how they calculate it for you. But obviously, with credit cards, of course, right? They have what's called the what do you call it? Credit cards are a little complicated because you can owe them for 20 something years.
Right, they're a revolving credit line, right? So it doesn't have a term necessarily.
Exactly. But in this case, this is a bank loan. Of course, there's a time to bank loans, right?
Right.
Yes. So you have to pay within this many years. And this is how you calculate every monthly payment. How much money is actually going to the interest and how much money is actually going to your principal. So, all in all, you're going to end up paying $2,000 if you don't pay as much, right? Because if you obviously pay more, you're going to pay actually towards your principal versus your actual interest. And the interest shall decrease over time. The more that you pay, the less interest that you are going to get charged. Okay? So there you go. That is it. And I shall post the answers on the Google Classroom. So right now it is exactly 3:26. So I'll call it. So please be back at 3:45. So I'll give you, what's that? Exactly 19 minutes. Okay?
Oh, all right.
All right.
All right. Thank you.
Mm-hmm.